Correlation risk is one of the most important yet often hidden forces in finance because it explains how different risks that look separate at first can suddenly move together and create large losses at the same time. And this is exactly how small individual problems turn into big system-wide crises. In simple terms, correlation risk means that assets or borrowers that normally behave differently start behaving similarly. So diversification stops working. And when diversification fails, we face two major dangers called systemic risk and concentration risk, where systemic risk affects the entire market and concentration risk arises when exposures are clustered in similar assets or sectors. When we measure market risk coming from interest rates, exchange rates, equity prices, or commodities, we usually rely on tools like value at risk or expected shortfall, and both of these models depend heavily on covariance and correlation between assets. Because portfolio risk is not just about individual volatility, but about how assets move together. So if correlations increase unexpectedly, the model severely underestimates losses, especially during extreme or tail events where correlations tend to spike the most. This makes expected shortfall very important since it focuses specifically on worst-case losses, which are precisely the times when correlation risk becomes strongest. Correlation risk is equally critical in credit markets, where we deal with migration risk and default risk. Migration risk meaning that a borrower's credit quality gets downgraded, which raises the probability of default, and default risk meaning the borrower completely fails to repay. But the bigger issue is that defaults are rarely independent because during recessions many firms suffer together, leading to default correlation. And that is why institutions and rating agencies such as Moody's carefully estimate default probabilities and how they change over time across ratings and maturities. When we look across firms and industries, we notice that companies exposed to the same economic drivers tend to default together. For example, energy companies during an oil price collapse or real estate firms during a housing crash, while firms in unrelated industries show lower correlation, which is why banks and investors diversify across multiple sectors to reduce the chance of many simultaneous losses. Another important idea is the term structure of default probabilities, which tells us how risk evolves with time, where investment-grade bonds usually have low short-term default risk that rises slowly over many years, while speculative or junk bonds have high immediate default risk, but may stabilize if they survive the early period, showing that both credit quality and time horizon matter in risk assessment. A classic real-world example of correlation risk turning into systemic risk occurred during the global financial crisis when Lehman Brothers filed for bankruptcy, which created panic across the financial system. Credit markets froze, liquidity disappeared, and stock markets around the world fell sharply, including major indices like the S&P 500. And what made the crash worse was that correlations across stocks jumped dramatically, so almost every stock declined together, meaning even well-diversified portfolios suffered heavy losses. Studies show that during normal periods, stock correlations might be only 10 to 20%, allowing diversification benefits, but during crises, correlations often rise above 50% or even higher, which means assets move in the same direction and the protective effect of diversification almost disappears exactly when investors need it most. However, not all sectors behave the same way because some defensive sectors provide essential goods and services that people continue to buy even during recessions, which gives them lower correlation with the broader market, of which tend to remain relatively stable because consumers still need low-cost goods, education, or at-home services during tough times, and these sectors therefore provide better diversification benefits. Finally, concentration risk reminds us that even without market-wide stress, holding too much exposure to a small number of borrowers or one single sector increases vulnerability, and we often measure this using a concentration ratio. For example, if a lender has 100 equal loans, the risk is well diversified. But if only 10 loans exist, each one carries much higher weight, and if those borrowers are also highly correlated, one shock can cause multiple defaults together, multiplying losses. So the overall lesson is clear and powerful. Correlation risk connects market risk and credit risk, reduces the benefits of diversification, increases the chance of simultaneous losses, and becomes especially dangerous during crises, which is why effective risk management always focuses not just on individual asset risk, but on relationships between assets, industries, and borrowers. Because when correlations rise, risks combine, portfolios suffer, and the entire financial system becomes more fragile.